July 3rd, 2019, another day in paradise, guys. Keep in mind we have a shorter session today. And man, some of those days, they're just no fun because things are just not moving. So with that said, just expect the market to trade on very, very, very thin volume today. There's two things that are easy predictions when markets trade on extra thin volume. As you know for a fact, VIX is not moving higher. VIX is either going to drop or it's going to go sideways, which for any one of you that's been signed up with the 13 Market Moves Daily, the easy conclusion is this. When VIX is trending sideways or going lower, what is one thing that you do not want to do? Guys, you don't want to buy puts. The clear exception, of course, is some individual stocks that are prompt to drop because of their own heavy weight, meaning specifically because of some kind of information that hurts that particular stock without the impact of the rest of the market on that stock. So directional options on such days, they're tough. So remember, when VIX is going sideways or going lower in a continuous downtrend like what we've seen, the easiest strategy is to simply buy stuff in the money. Buy calls in the money specifically is what the formula is telling us we should do, and be a little bit more patient. So with that said, let's review the key things. There is going to be money made today, guys. One of the things, I'm actually planning on recording a brief video about it, is the options premiums. And this is something to get really excited about. In a low VIX environment, your option premiums are deflate. So for those of you guys that have been trading with us when the markets were dropping like crazy in October, November, December last year, remember, just to buy like one option of Amazon, weekly option that expires like in 3 days, I mean, you have to pay like $30, $40 for it just to get it close to the money. Right now, I mean, guys, the easiest trade yesterday was just buying some Amazon calls. When Amazon made the dip to like 1910, 1908, your 1925 calls, I happened to add some more of those. 1925 calls, they were like $4. And by the end of the day, they were worth 15. So this was an easy 300% trade, and Amazon is opening a little bit higher today. So those calls, by the end of today, probably going to produce 400 or 500%. Now, I know for some of you that have been trying to follow these Amazon trade, it hasn't been an easy trade, but now it is an easy trade, guys. So on days when finally it's breaking out of the charts, the simplest strategy you can do is just add to the position. And what makes it such a good trade now is the option premiums, especially the ones that expire for this Friday. They're so deflated in relation to historic valuation of the cost of options in Amazon. What you're really doing is a really smart trade because you're controlling the costs. In other words, you're paying very little, and with that, your percentage gains always increase. Okay, so one way to get highly profitable with day trading or swing trading is to really pay very close attention to how much you're actually paying for the option. And so the opportunity right now is such that the option premiums are in traders' advantage because of the thin volume, because of the July 4th weekend. Nobody's really expecting any huge moves. However, based off our calculations, we believe we're going to get a huge move on a Friday. We'll talk about that briefly. Now, yesterday we put a note saying, hey, let's observe Tesla. Depending on what Tesla does, it could tell us exactly where the FANG stocks are going to go. So after hours, Tesla does stage a pop. We noticed earlier, we sent a message in chat room, right? Hey, looks like they're buying the dip in Tesla intraday. So that was the pre-existing condition to the pop in Tesla. I know some of you picked up some calls, so great job, guys. I only got a few calls on that one myself. So, you know, clearly when something, an event comes out, especially with stocks like Tesla, it really pays sometimes to wait. And in cases like this, clearly some of you wish, oh man, I wish I bought some Tesla calls, which is fine. Don't feel bad about it. The question is, where's Tesla going to go next? And we're going to take a closer look on that on the Tesla chart in just a second. One interesting thing I wanted to share with you guys this morning is we're actually getting a divergence which we have not seen in a long freaking time. Yes, we've talked a lot about how Nikkei futures, the futures of the Japanese stock exchange, they have been really almost a leading indicator overnight of how U.S. futures were acting, and the correlation has been extremely strong, like over 90% correlation. And we're noticing that relationship is breaking. What I mean is this: a Nikkei futures overnight dropped by as much as 160 points. Typically, that would cause the S&P futures to tank as well. Typically, when we see 160-point drop in Nikkei futures, we would see S&P futures maybe dip like 10, 12, maybe 13 points, something like this. Well, we got exactly the reverse of this today. So while Nikkei was dropping, S&P was actually going higher. And I'm going to point out on the chart, it's important to observe how they were going higher. So when you see the steady action, when the futures overnight are just climbing slowly but steady, that tells you nobody is worried. That tells you that the VIX is not going to be breaking out higher, making any moves to the upside. So that confirms that markets are going to be nice and steady on thin volume. But those are great conditions for some good stocks, because in the past, many great trades I've taken were in environments like this, just really buying call options and sticking to them, guys, on FANG stocks. FANG stocks like Amazon, Google, so on, they can actually go on days like today when the market is trading in a really thin volume. These stocks can still go 20, 30 bucks higher on like super light volume. That's why when you look at it from the standpoint of the cost of option versus the actual move in the stock, that relationship today is greatly in the trader's favor. So great trades could be put together, guys, especially, hey, some of you that trade in a smaller account, guys, today, Friday, is going to be some great days for you where you can buy literally some contracts on Amazon for like a couple of bucks. You know, $3, $4 that could be worth, 16 to, 24, 30 bucks by the end of Friday. So be careful. Just don't jump all in and just buy them at, all in one shot. I'm going to share with you why you may not want to use that strategy. And the third observation is really interesting, guys. We're getting official confirmation. So sometimes when I observe a certain behavior, and the behavior we're talking about here is the last hour rush, is what we like to call it. Last hour rush is when all of a sudden, the whole day the market doesn't seem like it's doing a whole lot. And then all of a sudden at the end of the day, boom, all these buyers, they're coming out of nowhere and they're just buying stocks like crazy on a significant spike in volume. So the meaningful part here, and the meaningful part of the observation is the fact that the volume goes significantly higher. And oftentimes when we look at the chart and it's confirmed by also an accumulation distribution going higher, that really tells you, well, what the heck? Why are they in such a rush to buy? Well, and that gives you this observation of institutional behavior, really gives you a valuable insight as far as what they could be thinking about the upcoming job report. So clearly they would not be doing that if they didn't think the job report was weak. Now, there's still, clearly they cannot be certain whether the job report is going to be weak or strong, but it really tells you that the way institutions are positioning themselves going into the job report really tells you that they're expecting the job report to be weak. So when we're making these estimates, and we're going to make some projections here in a second, we're really looking at this institutional behavior that tells us, hold on, why are they consistently buying 3 days in a row in the last hour? Because they're trying to position themselves for a bigger move. Nothing has changed as far as our strategy on the call side. We want to stick with the calls. Yes, we're still bearish on the BYND. Now, because the markets are so positive on thin volume, BYND could take its sweet time to fall, but it is heading to 130s, 120s. It's heading to 100 bucks. The question is, with the market being so positive, could it slow things down a little bit? And I think the answer is yes. So it doesn't, however, rule out the fact that BYND could trade by Friday to 130s, back maybe to that 135 level. So with that said, a lot of institutional behavior we're noticing is going to Chinese stocks. I had a good question yesterday. Well, what about BABA, NTS, or Baidu? Which one? Which one should I buy? You know, and my response was like, well, between the three, I personally like BABA and NTS better. I do like Baidu, and so I'll give you guys a quick answer just in case many of you were thinking about what the difference is. So number one is, when markets are dropping, like we just had a drop like a month ago or 3 weeks ago, right? You want to notice which stocks are actually falling by the least amount, because that tells you, like, if the entire Chinese sector gets hit, well, some stocks are going to drop by a significantly larger amount than some of the others. So the ones that actually hold up well in overall very negative environment for the entire sector, those are your leaders. So that's how you know that, look, these guys, even when things look extremely bad, they're holding up in relation to the other stocks. So Baidu's got hit real hard. BABA on relative basis, like if we're to compare it to the Baidu, this one did not get hit as hard, and neither did NTS. Now they all experienced some decent drops, but Baidu took the largest hit. So there's two ways to look at it. Okay, why did Baidu take such a huge hit? If you look from the history, I mean, the stock is incredibly cheap. I mean, it's hitting the levels, though, in the last month where it basically got to like 108, 110 level. I mean, it was hitting levels that we haven't seen in the stock in like 8 years. 8 years ago, it's traded at 100 bucks, 90 to like 100, 110. It traveled all the way to 240 and then, you know, back to the 110. And the interesting part is, well, basically the investors are calculating, hey, maybe there's some substantially, maybe a huge difference with the company itself. So that's why it's taking a much higher hit. Clearly, the last earnings report, it was taking a hit on earnings numbers, sales numbers, so on, forward-looking projections. It was just, the report was just horrible. So the stock got hit real hard. At the same time, it broke some many key levels. Now, sometimes when a bigger move in overall what's a really good stock, it will get a strong bounce. And so one way to look at it, okay, this one is positioned really nicely to go through that really good bounce. But overall, between choosing something that got hit really hard like this for some possible internal issues, I would rather go with something like this that does not appear to have those sales issues or earnings per share issues or guidance projections, and overall held up nicely, because typically these are the leaders and they will bounce. They will have a probability of bouncing much faster. But at these levels, right, we're talking like long-term wise, I mean, Baidu is probably going to go back to 150, 200 bucks. The question is, if you're buying options, if your goal is to really profit from like next 10 days, for example, and you're looking to buy these options, then you're much better going with a leader that has not dropped as much, that has overall a higher chance of bouncing, opposed to something that has taken a substantial hit, because even though it's a great value, it's a great buy, but in relation to your time frame of how long you're planning on staying in the trade, this could be not your ideal choice, because even though overall the stock is going substantially higher, you don't know the timing factor at this point. So within 6 months, sure, I mean, this thing is going to be way higher. But overall, for the short-term trade, you want to go with something like this. So hopefully this explanation helps somebody out there. Let's take a look at one of the concerns we had yesterday on the S&P 500 and some other indexes. We're pointing to these black candles. So today, this concern is cleared. Actually, this is a snapshot of July 2nd, so I took that after hours. And basically, that black candle, we've talked about the formation of the black candle. It wasn't a bearish reversal black candle. It was actually a bullish reversal because the tail of the candle was sticking right here underneath the candle. And then on July 2nd, we get a follow-through with the same type of candle formation. Now we're actually getting the white candle with the tail sticking down. That is actually a bullish reversal candle. So after that black candle, it did raise some concerns because the formation was not like 100% clear across the board on all indexes, but after we had a follow-through with another bullish reversal candle that really gives us a confirmation and clears that concern and really creates a pathway for S&P 500. Look at how perfect this how perfect this cup with a handle is, right? This breakout could be easily 10% from here, guys. So 300 points higher on S&P in the next 60 days. Tesla facing major resistance. So a lot of you are probably wondering, okay, I didn't buy calls on Tesla yesterday, and this morning I'm just trying to figure out what the hell am I supposed to do? Should I buy some calls now? Should I short this thing? Guys, I wouldn't do either. I would just focus on putting some easier trades, because at this point, historically, and I only got the daily chart here, but if you look at the longer time frame chart in this, on like a weekly chart, you will see that this level of 250 for a couple of years, it has been a huge support level for the stock. But since we've broken below that level, it is now going to act as a resistance. So what you want to do is really wait until Tesla breaks above a level 250, and not like where it just touches 250, because if it just touches 250, it could drop back to 245, 240. But if it solidly trades on huge volume above 255, 260, that would be your actual area to get in on the call side. Okay, so keep that in mind. You don't want to short it either, because the numbers are good, and I think the bulls are going to try to protect this level. So there's really no trade here, because it could easily go $5 higher, $5 lower. It could go $5 lower first, followed by $5 higher. There's just, what I'm saying is, after the 7% pop, there's just not a solid trade here. However, if you're considering putting on a trade here on Tesla, I think the shorts are going to be running. If Tesla hits a level of 255, 260, we could get a quick short squeeze, maybe all the way to 280 in this thing here. Now, there's still plenty of things bearish, and this chart is not reflecting the after hours action, because the stock did move to like 240 level after hours. So until that point, there was still a lot of bearish things on the chart here. So depending on how things are unveiling over the next few days, 250, if it hasn't to break above 250, could be an actual good level to come in and short this thing. So we are going to be paying a close attention to Tesla over the next few days. Okay, so guys, the Goldman Sachs trade. Hey, apparently at this point, we're not the only one thinking that Goldman Sachs is going to break out significantly higher. I was reviewing some stuff yesterday. Check this out. CNBC was talking yesterday about making a bullish case for Goldman Sachs to break above 210 level on the way higher. They drew all kinds of charts, comparisons, parallels, and so on. So they think that it's going significantly higher from here. So they're a few days late, but hey, still, you know, I thought it was just funny that they're on the same trade 3 days after we started talking about it. Okay, 4 outcomes of job report this Friday. Outcome number 1. Initially at 8:30, the market spikes lower, and then it moves higher. Outcome number 2, it goes sideways. Outcome number 3, spikes slightly higher, makes a pullback, moves higher, makes another pullback, and continues in such fashion throughout the day. Initially spikes higher, and then drops. Now, these 4 outcomes, based on what we're observing as far as the institutional behavior, we think that there is a 50% probability we're going to get this. So earlier I was saying, make sure you don't go and just commit your whole account, load up on a ton of call options, because you really want to be able to participate in this job report reaction. And you will have a much greater opportunity, especially if you're looking to day trade Friday. If the initial reaction is going to be this, you're going to be able to buy these call options at the best price on the dip. And since the dip has been the predominant behavior in the market, this is why we're signing this 50% probability. So this one, in our view, has a much higher probability than the rest of the outcomes. And you want to still hold a position on the call side going into the job report, because we think the second likely case scenario is this, Because again, why would the banks be running in every last hour of the trading session, buying a ton of stock, heading into this job report? So we think between this and this, overall, it's going to be a move higher on Friday. And clearly, we could be wrong and we could miscalculate the fact. We think the traders are going to be there. But if there's not going to be as many traders there, then we could see just the market kind of floating sideways a little bit. Now, we only assign 10% probability to this outcome. So basically, we think the highest probability is going to be initial move lower followed by a move higher, initial move higher followed by a move higher. So 70% probability of markets moving higher, 10% probability moving sideways, and only 20% probability of the markets actually dropping. So consider these outcomes because, again, especially for you guys trading with smaller size accounts, trading Friday expirations, this is going to be your ultimate entry, is buying calls when the market dips. Now, sometimes, because the job report is announced at 8:30 in the morning, you're not going to get to participate in the dip. In other words, the market is going to receive the announcement at 8:30. The immediate reaction could be lower. And then, let's say, by 8:45, it already moves higher. So by the time the market opens, this move has already taken place. And what you actually get is a gap up higher when the market actually opens at 9:30. So therefore, it does make sense to keep a call position. So if you're trying to make that decision today, should I keep my calls going to the Friday job report announcement? Yes, the answer is yes. Just make sure that you don't have your whole account tied up, because there's still a 20% probability that something crazy may happen and we may have a pop and drop type of scenario as an initial reaction, maybe which later in the following week could be reversed. But you don't want to get caught up with your whole account if the job report reaction is going to be this. So with that said, position yourself properly, guys, and manage your accounts. All right, basically we're very close to our analog doing this right here. So expect overall 70% chance of creating this white candle on a Friday. So your ideal trade is buying the dip and cashing out on your call options at the very end of the day, literally like 3:50 p.m. on a Friday. Beginning of a 100-point move started a few days ago when we hit this low, 29.14. At this point, these are your day-to-day reactions. We've hit 29.80, and this morning we're actually breaking above that. So we've talked yesterday how resistance becomes the support. So that level of 29.58, 29.60 has officially become a support after yesterday. On this illustration should really help you understand this. So this gap that was created, now we've pulled back to that level once and they bought the dip. Yesterday we've pulled back to that level again and they bought the dip again. And so in a way you can think of this as a double bottom. And when the stock market is an overall uptrend, these double bottoms, they will create these breakouts higher, which is exactly what we're getting pre-market so far, guys. So it looks like, you know, we're just within a few points from the 3,000 level at this point. Who knows, by 1 p.m., maybe we can come close to like 29.99. So that would be remarkable if the market hits 29.99. Hey, Trump may just tweet a couple of things to get it over 3,000 level. That would be something, huh? I think that would be hilarious if he did that. Okay, market move for yesterday, July 2nd, is a move 7 again. Yes, guys, we are officially getting 4 7s in a row. Again, this tells us this is not the time to be a bear. This is the time to be a bull. This is how yesterday move looks. It was a bit tricky because initially we opened just a bit higher, like a point or two, and then we started selling off immediately. They bought the dip. Then we had this spike higher. Initially looked like a move 8, like we're just going to break out and go to the moon. But then this second, more meaningful move happens to the downside. We actually dip in the red zone. And in some rare cases, if you study the 13 markets move formula, we will get flipped to the negative territory but not by a lot, not like by 20 points or 30 points. We could dip into the negative territory by 2, 5, maybe up to 10 points. That's exactly what happened yesterday. They bought the dip, and after that, it was just smooth sailing from there. Now, the important part about yesterday is the confirmation of this behavior, right? Look, going into this last hour, look how the volume was here, and look in the last hour how the volume spiked significantly higher, which coincides with the accumulation distribution. Look, accumulation distribution throughout the whole day was just kind of going sideways. And look in this last hour, last 30 minutes, last 15 minutes. This has been the predominant behavior of day-to-day trading. So for those of you, again, that trade with small accounts, what you could do is just really time this last 30-minute pop, which pretty much at this point happens daily. So you could be buying options right here, maybe right about 3 o'clock, 3:15, expecting a pretty good sizable pop to the upside by 4 p.m. And you can literally make some substantial money right here, from here to this here. This is a good size move, guys. The question is, last hour buying behavior continues. Why? Well, it's certainly not because institutional investors are scared of a strong job report, right? Strong job report means Fed has no reason to cut the rates. If Fed does not cut the rates, the market is clearly dropping. So if that was what institutional investors were thinking, clearly we would not be seeing this type of buying behavior for the last 3 days going into the close of each session. So what that tells us is they're not scared of the job report. What that tells us is they've probably done their homework and they have calculated that the job report is going to be weak, and they're continuing making these big purchases on strong volume multiple days in a row. So that tells us the probability of the strong job report is not likely. Second day sequence, 2-day sequence is 7-7. This is how this one looks. Again, this one's been a bit tricky because we had a gap up followed by kind of an unusual drop and a pickup. They bought the dip here again. So we opened higher, finished higher. And yesterday, same time behavior, just buying the dip behavior, right? We stopped pretty much identical after testing the same level. The low the day before was 29.55. The low yesterday was 29.58. Basically within just a few points. We test the dip, they buy the dip one more time, and there it is. The market shoots higher. 5-day sequence 2, 7, 7, 7, 7. Man, unbelievable, guys. Wow. If we get another 7 today, this is going to be unreal. So clearly, guys, it's just a combination of a lot of these reverse head and shoulders. We've noticed one at 29.14. That's when we said this is a TRO, trend reversal. The market's going to move higher. Since then, we've got another reverse head and shoulders. We got another reverse head and shoulders. So between these, we're seeing continuation in this buying the dip behavior. We've had many, basically every dip was bought here, which resulted in a breakout in a gap up higher. Now we're seeing the same behavior continuing here, which basically Friday could result in another gap up higher. When we overlay this over the analog of December 2017 to December 2018, we get an identical reading almost day to day. What's important, however, is it may be time to take some profits on Friday, not on all of your positions, but on some of the positions, because the analog actually points that after the second gap up higher, so if we do get on Friday something that resembles this, if we do get a gap up higher on Friday, be careful, because the following few days, remember I keep talking how about even though the markets are moving higher, not every day is going to be a day higher. There's going to be some red days. So it may be prudent and wise to take some profits on a Friday at the highest levels on Friday, or right at the market close, like 3:50 p.m. on a Friday, 3:55 p.m. on your call options, in the expectation that possibly the market could just stall out a little bit for a couple of days before resuming this bigger size move higher. So just keep that in mind, guys. Okay, So we've talked about a lot about these reverse head and shoulders. We keep noticing them again and again and again. This bind the dip behavior resulted in a breakout and a gap up higher. We think that this is exactly what's going to take place again. So kind of expect the market to be doing this today, resulting in a breakout higher on Friday. Next market move, meaning today, because of the low thin volume, we can easily expect a 5. So no huge moves, but overall positive. Move 7 could be a 5 days. We could be going into the 5th day of a move 7. That would be absolutely insane, and clearly just a easy probability of a move 1. So 5, 7, 1. We're not expecting any crazy reversals. Just as easy as this environment can get. Because of the slower volume again, and yesterday VIX hit some lows that we've not seen in a while. Hit a low of 12.9 heading into the close. It is numerically low. It is in a downtrend, so buy calls in the money. That's an easy strategy. And because of the lower volume, we're not expecting any upside surprise for the VIX. It's basically expecting to go sideways or to continue dropping down slightly. What we've noticed yesterday and discussed was the fact that after creating this multi-top formation, VIX created the head and shoulder, which typically results in a drop. So from 14.11, it does exactly that. After creating this head and shoulder formation, VIX hits drops out of that head and shoulder formation, hits a level of 12.9. So far, pre-market to the point I'm recording this, it's at 13. So having a hard time bouncing off these levels. The markets are just really solid right now. Okay, with that said, guys, the key takeaways: do not go all in before the job report. Wait for reaction first to add to the positions. Be patient, get more time on expirations, and do focus on easy trades like Amazon. It's finally moving. It's finally catching some traction out of its own cup-with-a-handle pattern. It's about to, I think, get some serious traction, maybe 100 points higher over the next 72 hours. So for those of you that have been patient with the Amazon trade, guys, congratulations. It's about to pay off. So good job on staying with your position. Sometimes that's all it takes, guys, is to get a good position and just stay with it and not jump in and jump out of it. So with that said, guys, be ready to day trade. Friday could be an awesome, wild day. I certainly look forward to you. I hope everybody gets a ton of rest tomorrow for July 4th. Happy holidays to you and your families, guys. And, hey, do catch an extra hour or two and study up some of these courses, guys. If you have not taken Trade Like a Rockstar course, man, the earnings season is about to kick in full blast. So you definitely want to review that. If you haven't taken that course, you definitely want to pull the trigger. There should be a link somewhere below this video. If not, just go to tradingoptionslive.com. There should be a link there. Study up so you could have an awesome earnings season that's coming up, and literally here in just about 12 more days. It's gonna be fun, guys. So enjoy the holiday, and I'll see you in the video on Friday.